The S&P 500 now is up 25% from the April lows. And because of that, there's one undeniable fact. There are a ton of bullish chart formations. The big question is, can we trust them? So today we'll be looking at the bullish patterns themselves and a host of indicators to come up with that answer. So let's start with the bullish patterns. So as we know, on the way down from the February high to the March low, the first stop there, all the way to the April low, we're looking for bullish patterns because, of course, that's what we do when the market is in an uptrend or downtrend, to get an idea of what type of market that we are in. As we know and as we reviewed many times, the number one factor for an uptrend to actually work out is to see successful bullish patterns play out over and over again. All right, we saw that over the last 2 years. And so on the way down, there weren't too many examples of this, but as you may recall, we did see the first semblance of a bid happen in the middle of March. And that ultimately created that bearish flag pattern, which is much more visible on the daily chart. On this 2-hour chart, though, as that was being formed, we identified this cup and handle formation, which had an upside target of 59.10. So we got about a day and a half's worth. Of course, the extension was short-lived, and that was negated. So again, it told us that yet another bullish pattern had failed after seeing 3 of them fail right before this one. So on the way down, of course, we had to wait until the big pivot low on April 7th to get another sense of another formation being set up. And we know what happened after the huge April 9th advance and then the ensuing pullback. This potential cup and handle pattern also got negated. But we know in hindsight that wasn't the end of the story, so we continued to look for more iterations as things went on. And as we can tell right after that, as it undercut that line here, or the breakout zone, another key, and this was the most important higher low we saw develop, that created a breakout, and we hit the 58.40 target soon thereafter. So looking more closely at this, we know all of this then became a bullish pattern in and of itself, which created this identifiable cup and handle pattern on the daily chart, which we saw the breakout on April 25th, which produced an upside target of 61.25, which we know has continued to be in place since that point. We got the initial test of the breakout zone in the first few days and then up from there. And from that point, we can then draw a much bigger formation, this inverse head and shoulders pattern, which had a breakout just a few weeks later in the middle of May, which produced an upside target of 65.55, so much, much higher. But with all these bullish patterns, as the market has continued to float higher, it just created more of a cushion of which the S&P can potentially pull back to regroup, see some of the stretched indicators that are currently out there, get back to neutral territory, and then, of course, form more bullish patterns from that point. And that's what's happened over the last week and a half, even from a very short-term basis. It's a 2-hour chart. Saw a Mars zone breakout, produced another upside target of 61.20. Now, altogether, that gives us 3 live bullish patterns right now after the action from Monday, June 9th. And we can see that 2 of them are very close to being acquired, less than 2% away, with the breakout from May 12th, again with the target of 65.55, still about 9% away. That's all good, and we want obviously to see those targets get acquired, but we're more concerned about how far these bullish patterns are from their respective breakout zones. Now, again, we know this short-term one, the small pattern we just reviewed, that can get negated at any time. There's always news that can move this. We've only had 1% decline now since April 21st. So at some point, we're going to see more of that. I wouldn't be surprised to see volatility get a little bit more elevated than it has been recently. And if that's the case, again, a short-term formation could get nullified. But the bigger ones now have a good amount to potentially pull back, right? Think about it. The one from April 25th, we're almost 9% above that. So if you think about a big move from this point, 8 or 9% down, that will cause a lot of alarms, but still have that bullish pattern still be in play. And that's really one of the things we stressed in 2023 and 2024 as those bigger bullish patterns are playing out, that the market just had the ability to back and fill a bit, which it did numerous times, to digest and then form additional bullish formation. So of course it goes way beyond the S&P 500. We just ran a simple screen right before this in the S&P 500, and over 80 stocks popped out. And so these are just a few of them in alphabetical order, and we can tell very similar patterns for each one. We had a potential, the low in April, higher low breakout, and then additional formations being formed right now. There are some variations here, but for the most part, they look the same, all making a major low, higher low, breaking out, consolidating, trying to do the same thing now on a shorter term basis too. And so, as we know, another key part of any uptrend is that we just don't see bearish patterns play out. We reviewed this over and over again, but we continue to talk about it because in strong uptrends, you just don't have bullish patterns and bearish patterns working out simultaneously. But along the way, just like on the way down, we're looking for bullish patterns. We're always looking for bearish patterns as well because the trend may change once more. And before we know it, bearish patterns could start to work. So when we're looking at right now, as the market continues to float higher, at any point here, it could just turn lower. And we already have a potential left shoulder in play. So, as if, for instance, you pull back to say the 5,800 line here or thereabouts, get a bounce, another lower high. What do we have? A head and shoulders formation more specifically. And with that, again, potentially occurring right in the same zone where the S&P started to fade at the end of 2024 and into 2025, when these bearish patterns started to work, then it gives us some pause, or at least the understanding that it could happen, right? And if that does happen, if we do see topping patterns start to form, those will eventually, if they eventually get resolved to the downside, they ultimately then would negate each one of the bullish patterns that we have in play. Hasn't happened, right? Haven't even seen the formation, let alone a breakdown of a bearish topping formation since the lows, but it's something that we'll always be looking for going forward. And so an obvious negative or potential negative for this market, considering how strong the run has been, is that we're just extended, right? As we mentioned, S&P is up now 25% with hardly any drawdown from the lows. So that's extremely strong compared to even going back to 2022 with the strong bear market rallies along the way, right? And we saw a 21% move from the March low to the July high in 2023, and then from the October low, as we know, up until March high before that 6 or 7% pullback. So any way we measure it, it's getting to the point where that rubber band is really stretched over a very short amount of time. And remember, 25% happened over 2 months, right? And so we don't have to analyze that out to understand that pace just can't continue. And of course, the most bearish investors among us just think that this is really exaggerated, that rubber band is not only going to snap back, it may snap in half and bring this tumbling down to, who knows, maybe even close to the lows from April, right? That's one part of it. And we just have to see, because there is going to be some profit taking. It's really a matter of how the S&P can take a punch the next time that arrives. And of course, with that, there are numerous sell signals depending on which indicator that you look at. One we've talked about a lot and relied upon now for years, of course, is the MACD. And with the MACD having flipped historically from an extreme low to extreme high because of how highly priced the S&P 500 and its resultant moving averages are, we can see that there could be like a major sell signal in place. Now, don't forget, this sell signal was triggered in May, so it hasn't worked out yet. And remember, all the other times, we only have data going back to July on this chart. But as we know, from the October 22 low all the way to now, most of the MACD sell signals just didn't work out. And remember, we've shown that chart a lot. While the blue vertical lines that we have here, all that really did was lead to a minor pullback, which was bought. And that's what happens, of course, in uptrends, where sell signals that sometimes trigger major sell-offs in the MACD, in the market indicators, just don't work as well in uptrends. And with that in mind, I'm sure anyone who keeps track of the market indicators knows that there is a plethora of sell 13s out there, which is just a major reversal number. Last time we saw a sell 13, the S&P 500 was right near the top in February, just like this sell signal was for the MACD. So not a surprise that both of them are occurring around the same time after a huge run up with the market now kind of slowing down, if you will, after the huge amount of volatility. So needless to say, either the MACD and the Mark 13s will work out simultaneously or they won't. And we'll get a good indication, again, once more, how that happens over the next few days to few weeks. So in terms of breadth, there is some negative connotations on this as well. Now, one of the reasons is that if you look at the S&P 500 and below here, we have the percentage of its holdings above the 200-day, above the 50, and the 20. And as we can tell, these are all the peaks going back to 2022, and not surprisingly, they all occur near extreme levels for all of them, right? And so we're clearly much closer to the extreme highs than the extreme lows with the rallies. But two things pop out. Number one is that percentage of stocks trading above their 20-day moving averages from a high of 90% just a few weeks ago to now 60%, right? And so this shows that maybe momentum is shifting. Now, one way to think about that, though, is this: is the market or number of stocks rip higher so much, it's going to cut through the 20-day moving average first because it's the fastest moving one or closest to its price. And so eventually that rate of change is going to slow down, which it does, which allows the 20-day moving average then to catch back up to those stocks. So right now, there are a number of them then now are currently below the 20-day because the 20-day moving average is still moving higher. So eventually, if we see those consolidation phases resolve to the upside, they'll get back above that line once more. And that's, that will be indication, of course, of this trend moving higher. Now, the other part that really sticks out is that the number of stocks trading above their 200-day moving averages didn't even get back above 60% on this rally, even though the S&P has been through it now for 2 or 3 weeks, and now it's hovering in the mid-50s. So that is something that we need to see change because remember, from the October 2023 low, as things really got moving, this hovered in the 80s, 70s, 80s for a while. Even though we saw it slipping ever so slightly, the majority of stocks were above their respective rising 200-day moving averages. And as that started to change really in December of last year, that's when the foundation started to slip. So for this market really to get back to those uptrending ways that we saw last for a better part of 2 years, we not only need to see, say, 70-80% of the S&P 500 stocks get back above their 200-day moving averages, we need to see that stick for a good amount of time, again, for things to replicate what we saw over the last 2 years. Now, from a different angle, this is the cumulative advanced decline line. This is the S&P 500 on a monthly basis. Things look just fine. As we know, the cumulative line made new highs as early as May 2nd, but the S&P started to rally. And we talked about this in a few pieces and videos already, and that was really just because the stocks that were non-growth just didn't fall as far from their respective highs on the way down, and so it didn't take as much advancing price action to get most of them up, especially when you sprinkle in a handful of 90% up days. It really moves that needle. So this is, of course, supportive. We want to see that continue, especially as some of the larger cap names now are maybe gotten extended. We want to see rotation come back in, and there are a number of areas that could, of course, do well with capital flowing back to them. So in terms of the real positives underneath the surface, other than the patterns, the bottom line is strength begets strength. And we've all seen these studies out there, right? And these are just two examples. Number one, biggest 3-week advances since 2015. We see them here. Another one just happened as the market came off the low. And if you look at all these going back over 10 years, the ones in green, of course, show that the market continued higher in weeks, even months, sometimes years to come. The only 3 times where we had immediate rollovers that were very strong moves was in 2022 and 2015. So again, strength begetting strength, meaning that you have momentum kickstarted to the positive that then leads to more of the same. It doesn't say that we have to continue to get strong, ultra strong moves. In fact, we don't want that. We talk about that all the time, but then kind of gets the market trending higher. And consistent uptrends, of course, have characteristics of low two-way volatility, right? Another study to look at is we've now had 3 winning streaks of at least 5 days in a very short amount of time. So clusters of strong breadth, clusters of long winning streaks, again, more representative of an uptrend, of a healthy market than downtrend. As we can tell, going back again 2 years, this happened in 2023, happened in 2024, now happening again in 2025, off of the really extreme low, and now potentially turning this into a more consistent, trustworthy uptrend. And so as the market was rolling over, as we know, it looked very much like 2022, right? It happened right around the same time, of course, in the calendar year, the very beginning of the year. It happened after 2 strong preceding years, S&P 500 up 20%. But the big thing was the excessive volatility, right? Whether you look at the VIX, whether you look at the number of 1% moves, which we do, it just we just hadn't seen this happen since that point because of how 2023 and 2024 played out. Another example is the S&P versus its weekly moving averages. We look at the 13-week, 26, and 40-week. So one of the key parts of 2022, which showed that things were changing, is when the S&P not only undercut those 3 lines on the way back down, it failed to capitalize on getting through them when it did in the first bear market rally in March there. And as we can tell here, the 26-week undercut the 40-week here and did not reclaim it until late March, early April. Talking about a year's worth, right? So those are slow moving averages to get back. Whereas right here, even though this was an extreme move to the downside, with the snapback happening so quickly and so strongly, that same blue line, the 26-week, barely grazed that 40-week and now is back above it once more, with the S&P, of course, above all those lines. So again, could this completely reverse once more? Of course, but if you're looking for differences with this compared to a real bear market, this is one of them that has popped up, and which we'll continue to watch, of course, on the next pullback. And then another huge difference now is just the low two-way volatility, which we track again using the 1% moves. I mean, we're talking about in March and April not seeing 12 1% absolute moves since 2022, especially having them happen 2 months in a row. It looked like it was just a repeat of the year, or even worse, as things were happening. And remember, this didn't really change from this perspective until April 2023, when the excessive amount of 1% moves month to month fell off a cliff. Similar so far to what just happened in May, and now again in June, with just 1% decline, again happening since April 21st, with 7 1% advances occurring around the same time. Remember, 2 of the key traits for an uptrend that we have are a low frequency of 1% moves overall, but more 1% gains and losses, and to the point where now we're almost even with number of 1% losses, which of course became excessive both in March and April. And so another part is just a trend. And we can look at this many different ways. We talked about using the go, no-go charts for some help in this regard. And this is a weekly version. As we review, this is a proprietary indicator, so we don't know what's exactly in it, but we can have an understanding that it's something momentum-based, possibly moving averages, so forth and so on. And so the hit on this is that it hasn't turned positive yet, even though the S&P is up 25%. So that's true, but let's remember what it really was good at doing. Going back to 2020, 2022, the last time we had bear markets was that when those eventually turned, it was after the low, but that's when the trend started to change. Remember, from a very volatile reaction to a huge amount of downside to a more consistent uptrend. So if that's the case again now, we get the go signal on a weekly basis as things started to turn, and we know that a good majority of the moves from that point, at least on a duration basis, happen after this change to go. And this could be happening again soon as we're getting close to new highs, which was the case in 2020 as well. So when we talk about patterns, it's usually classical patterns, and that's true. But we can also identify behavior on the chart in different ways. And this is one of the things we're looking at just over the last 2 years, where you have these pullbacks, a strong rally right off the lows, a higher low, and then the really big move happens. It happened from March to May in 2024, and then the big rally came through July. Then it happened from July to August to September later that year, and then the big rally came from the September low to the December high. And we trace out the same pattern again now, going from the lower high from March, of course, the big downturn, the big rally from that point, just the last few weeks, the minor pullback, another higher low. That could then lead to the second leg, or potentially the bigger leg of this move once more. And lastly, we can look at this from an even longer point of view. Going back to 2013, we know the market has been trending higher, but along the way, all of these pullbacks eventually led to major downturns, formation of bullish patterns, and eventual long-term uptrends. Now, all of this may seem like a stretch considering how far we've come so far, but we've seen this before. We've seen bullish patterns play out over and over again for sometimes over a year. We're going to talk all about that in this next video. Check it out.